Hello and welcome to the second blog, part 2 of the one for the 5th of February. As a continuation, Mr. Ekwunifi was asking about how do we know whether someone's hawkish or dovish. Just want to say one last thing just on this, in that really what you want to do is have an idea of what the language is and then wait for the market reaction to it. It doesn't normally pay to sort of jump on prices as soon as you see some sort of comment coming out, especially as a beginner. You're far better served to sort of digest the information and see the market's reaction to it, and then come to some conclusions after that. What this means is that the market is coming to you, you're not going to the market, so you're showing a little bit of patience and sort of trying to understand what it all means. It's quite possible that you could have a hawkish statement, and for whatever reason the market decides to ignore it, and the price goes the other way, and that can cause you some confusion. So thing is, learn to understand what the information means and remember what the price action subsequent to it was. A thing that is very big for me is what I call good news bad action, or bad news good action. So in other words, the market actually does the opposite to what the consensus would be, or the first move is very quickly reversed. This means that quite often short-term traders are on the wrong side, so they're going to be forced to get out and take their losses. And sometimes with very big pieces of information, it could mean that longer-term traders are getting involved as well. So whenever you have a time when both sets of traders are going in the same direction, that's when you get swift trends. Okay, the next question comes from Kahor or Nor, not quite sure how to pronounce that. And his question is asking whether the dollar Swiss can go up to 121.42. I'm slightly worried about this question in that, of course it can go to 121.42. Price can go anywhere apart from below zero in theory. What he's not saying is how long is it going to take to get there, what path down the yellow brick road is it going to take to get there as well, and where would his stop losses, where would he want to get involved. It brings up a very important point, which is to do with targets. As a beginner, as a trader, really, as I've said in the previous video, you want to be able to understand and qualify risk and make sure that that is being done properly, because if you do that, then you live to fight another day. If you put price targets on things, then you psychologically get attached to the price trying to get to that level, and there's all sorts of things that can go wrong there, not least the fact of how long it's going to take there and how it's going to do it. What happens if it just gets very close to your target and then doesn't quite make it and then reverses back down again? So what you need to do is normally have a methodology for trailing your stop loss so that it locks you into a profit. Having what I call partial exits. I always trade in blocks of 3. So whenever I put a position on, primarily I'm interested in taking some of that position off as a day trade type profit. I don't know, and I will let the price develop and tell me where that profit may be based on the way that I do supports and resistances. What I've then done is, it could be that the trade is going to develop into a strategic trade. I don't know that at the time, but it's important that if a trade does develop, that I've still got some of that original position left. So think about trailing stops, seeing whether trade can develop. I'm going to probably do a long webinar or video on how you can ride time frames and how quite short-term trades can ride into very long-term trades, which normally, I think for most traders, even in the professional traders, normally a good year is based on 5 or 6 home runs. Normally in any year I'll say that was a trade that I put on, I stuck with it, it carried on for maybe a few weeks and even some months, and especially with options you can get a lot of leverage with options. So normally that's how I make my money. A lot of the time I'm really just ebbing and flowing, taking a little bit here, a little bit there, but not making any big jumps in my profitability. What's the next one? Question from Andrew. It says, why did I take the position at currency and what makes currency unique? Well, they asked me, sort of being a trader than I have an ego, so it flattered my ego. I said, why not? On a more serious note, I think because I'm involved in education of the professional, in the professional arena, I think that there's a lot of bad information out there for the newcomer to the market. There's a lot of contradictory information. It's just full of it, and it's a bit of a minefield. There's also a lot of promotion that says that trading is very easy, trading is going to make you a lot of money. It's actually probably one of the most difficult things that you're ever going to do, and normally people who come to trading have been successful doing something else, and that's really the reason why they've got some money that they want to speculate with. And so it can become quite debilitating when you lose, in that you don't understand how you can be successful doing something else. And really, when it comes to trading, to a certain extent, logic almost tells you that it's a 50-50 chance. Price could go up, price could go down, but it just doesn't work like that. So I think currency, by showing people's trades, are making it real. People can actually see. You have the ability to sort of track people who are doing well. So, and it's not based on smoke and mirrors. It's all there for you to see. So I think also from a moral point of view, I know when I was younger, having a very strict Catholicism based upbringing, there was certain morals about making lots of money for banks and whether it was really something that I should be doing. And I think education and trying to help people is a way of me sort of putting something back and trying to give some insight and help people moving forward. Okay, I think we'll take this as the last one. Let's just see. Okay, is there a trading technique that is easier for beginners in Forex? Well, we actually come back a little bit to the question in the previous video. I don't think there is a particular trading technique. There are three main ways that I look at markets, and I'll list what those are. First one is I look at supports and resistances. I have a very specific way of how I do that with a study called Market Profile. I certainly don't believe what I regard as quite lazy technical analysis, where people will say that supports and resistances are the absolute highs and lows of swing patterns, normally based on daily charts. The fact that that was the high or the low means that there really wasn't any volume there at all. The high or low of the day very rarely has any volume. So the idea that it's support and resistance to me is just lazy, and Profile will show the true support and resistance much more clearly. The other thing is I'm interested in concepts of overbought and oversold, and again I use a very specific indicator to do that. The one thing I do not do, and advise everybody to do likewise, is not to put, I always get this the wrong way around, but not to put non-linear, data is non-linear, and then you put an indicator that is. That has an inherent flaw. So what I mean by this, price can go anywhere, but something like the stochastic or the RSI can only fluctuate between 0 and 100. So if we get on any strong trend, if we're in a strong uptrend, the stochastic will consistently be overbought. That tells you that we're actually trending. Personally, I like it when the stochastic goes overbought. It tells me that the momentum is strong. You also can get divergence. Just about any trend diverges, so whenever you read about divergence you have to be very careful. It can get you out of trend following trades far too early, and if you use it as a reversal indicator you'll lose money very quickly. I spent about 10 years working on divergence. Chapter 3 and 4 of the book look at it in detail, and even now I tend to use divergence as partial profits and as a warning sign, and only some very specific patterns that are relatively rare will make me go against that trend. The third thing that I look at is the time of day that we're actually trading, and the limits of range associated with normalized behavior. Depending on the time of day that you put a position on, this dictates risk that's available. If you're putting a trade on in the middle of the night, market's not going to move very much. Put it on 15 minutes ahead of payroll and it's going to go a bit crazy. So sounds a bit obvious, but I have specific indicators that tell me what the volatility is for the time of day and the chart I'm looking at, whether that's a 30 or a 60-minute basis. So those are the three things that I look at, and this is depending on how many of these things are lining up together, dictates how much volume I throw at the trade. Okay, thank you.